Data has been very strong, and outside of the labor market, most of the other data points that we've gotten, ISMs, et cetera, have also been somewhat surprising to the upside. So, given the fact that the economy is in a relatively good spot, the Fed does have a little bit of luxury in spreading out those cuts.
Subhadra, you're talking about the evening special on Sunday on C-SPAN. We want to talk about the B-movie, at least as Greg Peters was talking about earlier, the sort of drama in the background. In other words, to put it bluntly, how much does it really matter to you as a bond strategist what Stephen Miron says, given that he is a new governor and he has the full backing of the president?
It does matter. I think words do matter. I think the fact that if at least optically, when you have maybe 3 governors dissenting for the first time since the late 80s, I think that that's really going to stand out. And what would be interesting is if you actually have dissents on the hawkish side. And that'll really make the meeting very colorful. I mean, if I could, I'd love to be a fly in the wall in these discussions over the last couple of days. But again, I think that these statements and sentiments do carry value. I think broadly speaking, I think that's what the market's trying to suss out as well, because if you look into the end of next year, you're looking at pretty decent amount of cuts being priced in. So the market is assigning a higher probability for a much more dovish, Fed committee, FOMC committee next year.
So, Subhadra, Societe Generale is a Paris bank in a nation in a complete, total uproar. We all know the French story, the politics and all. This Fed meeting is invaded by politics. Does Jerome Powell have to speak to the non-financial America out there?
Yeah, he always does. I think that the messaging has always been very clear and simple. They do look at policy for all Americans, all sectors of the economy. They are going to take into account that there are certain sectors of the economy that are particularly coming under, pressure, especially if you look at, the employment side of the picture. We still have haves and have-nots economy. So Powell, I think, is going to be very, very focused on trying to keep basically all constituents of the economy in mind while changing policy. And that's part of the reason why I think it makes sense for them to front-load cuts, this year.
Kathy, 4 minutes, less than 4 minutes until we get that decision. If you were in the press conference, what would your one question be to Fed Chair Jay Powell, if you had one?
Well, I'm going to assume that whoever went before me asked about squaring up the dual mandate with the rate cut. And I would go on to ask a bit more about the concept of maturity matching on the balance sheet. This is something Governor Waller has talked about, and I think Stephen Miron might embrace as well. And I think that has some implications longer term for how the Fed proceeds and how the market develops. So I would definitely ask that question if I had the chance.
Balance sheet management, Bramo, keeps coming up, doesn't it? Yield curve control,
right?
All of these things, these questions keep coming up.
Yield curve control under another name. I mean, people start tuning out and they hear, tweaking the balance sheet and maturity matching. That is another way of backdoor yield curve control that a lot of people are trying to understand.
Kathy Jones of Charles Schwab, Subhadra Japa of SocGen, to the both of you, thank you. That decision is about 2 minutes and 30 seconds away. We've talked about this 3-part act. We got a statement, the forecast, the news conference. Let's just sit on the forecast. The Federal Reserve has to project and forecast not payrolls, but unemployment. And going into this, I wonder if we're going to be surprised more by how much the SEP changes or by how much the SEP actually remains the same. How much can these forecasts around things like unemployment for inflation actually change? And that's what's interesting about the moment. Typically, when the Fed is projecting more interest rate cuts, you'd expect a big downgrade to growth. You'd also expect an upgrade to unemployment. We might not get that in 2 minutes' time.
Especially given the fact that we're at a pretty neutral pace. Just taking a look at where we were, the projection was for 4.5% at the end of this year in terms of an unemployment rate and a 3.1% core PCE. It wasn't expected to shift that much on either front over the following couple of years.
John, I think what you bring up is a really, really important point. What confidence do we have in our guesses out to June of next year, December? Liz Ann Saunders had the map of the day. It was household insurance across America. Let me tell you, half of America's flat on their back with fixed costs surging.
This is the question, I think, for the committee today. and for the news conference too for Chairman Powell. And there was a key difference between how he addressed this question in July and how he's thinking about it over at Jackson Hole in August. What is anchoring your view on the labour market right now? Is it the unemployment rate? Is it measures of slack? Or is it payrolls growth? Because the Chairman Powell of July was very different to the Chairman Powell of August.
Who said that it was really important back in July to look at the unemployment rate and then the payrolls headline figure. The problem is, right now, people really dispute the idea that we have the same kind of labor market that requires the 150, 200,000 jobs created per month, and that this is more of a 50,000 a month kind of break-even rate that we should be looking at.
Do you get lulled into a bigger conversation, a bigger decision than you otherwise would have made? And that's something that this Federal Reserve has to confront today and for the next several months. That decision is 20 seconds away. The question is not if they'll cut interest rates. The question is by how much, 25 or 50, and how much can you project in the guidance, the forecast? Equities going into it just about unchanged on the S&P 500. In the bond market, 2s, 10s, 30s look like this. Your 2-year bond yield up by 3 basis points with your Fed decision. Here is Mike McKee.
The answer to your question, John, is a 1/4 percentage point cut as expected, but Fed officials also see 2 more cuts this year in October and December, according to the new dot plot. There was one dissent, and that is from Stephen Myron, the Trump representative on the board, who wanted no cuts this time. He wanted rather 2 cuts this time, 50 basis points. Next year, the committee sees only 1 cut so far, but the dispersion is very wide, and the very bottom dot for next year is at 2.75%, suggesting once again that is Stephen Myron. The committee sees that the risks to that they are attentive to the risks of both sides of their mandate, but they say the risks to the downside for unemployment have increased, and that's the reason that they are cutting rates today. They also adjust the forward guidance in the statement to drop the word extent and just say in considering additional changes to the target range in the future, they will consider all kinds of options. There is no real change to their economic forecasts, but we don't know exactly why that is, whether it's because Myron contributed different numbers than others, or Anna Paulson, the new Philadelphia Fed president, contributed different numbers than others. But the growth rate is marked up for this year to 1.6% from 1.4%, and the unemployment rate is unchanged at 4.5%. PCE inflation at 3% is unchanged from their July forecast, and core PCE inflation unchanged at 3.1%. There's no change overall to the balance sheet. And once again, there was one dissent, Stephen Myron, the new member of the board from the Trump administration. The rest of the board, including Mickey Bowman and Chris Waller, satisfied with moving the rate down to the range of 4 to 4.25%.
Mike McKee, thank you, sir. Stay close. We'll take some time to internalise what we've just heard from the Federal Reserve. A lot of information. Equities off the back of it, still just about positive by 1/10 of 1%. In the bond market, yields just a little bit lower at the front end of the curve, down by 2 basis points on 2s to 3.48. And foreign exchange, some euro strength, some dollar weakness. We approach 119 on euro dollar, which is its own story, which we'll get to later, 118.84. I want to do a couple of things. Let's take the forecast and just focus on 2025 and 2026. And I just want to focus on where the projections were in June and where they are now, and just go through this piece by piece. For GDP, compared to June, that's an upgrade for this year and for next year. For the median dot, we've gone from 3.9 in June down to 3.6 for now, so we're looking for another 2 cuts. For next year, we've come down from 3.6 to 3.4, and PCE has remained pretty stable, I've got to say, for this year. For next year, they're looking at around 2.6%, up from 2.4. So just get into this a little bit more. What an odd decision we've got here, Bramo, that this Federal Reserve, and you don't usually see this, has cut interest rates by 25 basis points, has increased by just 1 interest rate cut relative to where we were in June for this year. At the same time, they've upgraded growth, kept unemployment basically unchanged, and basically projecting CPI to be sticky and close to 3%.
And saying in their statement that inflation has moved up and remains somewhat elevated, as their SEP, their Statement of Economic Projections, suggests. So then why is the bond market rallying? Why are yields down, even at the long end, if this is basically the projection that inflation will remain high and they will cut into that inflation? And what this hints at, and this I think is really going to be interesting, is is this clear desire by the Federal Reserve to overweight the economy, even allowing inflation to run hot, and they will keep cutting despite that inflation. That is what is getting translated into this market.
I want to cross back over to Mike McKee if he's still with us and hasn't run off to the news conference just yet. Is Mike there? Good. Mike, I want to come back to you. How original is to see this, to see a rate cut, to see the projection of more to come, at the same time all these other things are happening with the forecast? How can you explain that?
Well, I think there's two possibilities, and they both center around the new members on the board, Anna Paulson from the Philadelphia Fed, and most probably Stephen Myron. When you look at the range of the forecasts for GDP, they moved up the bottom range and the top range, and the same is true with the unemployment rate. It didn't move at all, but inflation didn't move. And it seems that Myron probably put in stronger growth, lower unemployment, and at least unchanged or lower inflation going forward. And
for years, led by the chairman of the Federal Reserve, Jay Powell, who stepped into the room. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.